Hi friends, Simit here from InformedTrades.com. In today's video, we're going to look at the return on equity valuation metric, what that means, and how traders and investors can use it to find stocks that might be undervalued. Let's get started. Okay, key points. We'll start by defining return on equity. We'll take a look at the pros and cons of what this indicator actually means. We'll look at some back-tested results on how the indicator has performed over the past 15 years or so. And then as well as sample usage with a screener, how we can actually apply return on equity to identify stocks that we may be interested in. Okay, so what is return on equity? Basically, it's a pretty simple formula. It's net income, this means income after taxes, divided by shareholders' equity. So it's assets minus liabilities. Another way of thinking about it is net income over net assets. So it's the return on what the company actually owns, on return on what the company's. It's very similar in a way to the price-book ratio. We're trying to get, while price-book is comparing the share price to the book value of the company, market capitalization to the book value. This is more so about comparing income, so earnings, how much is productive assets relative to the net assets the company has. And we talked about this a bit in our price-to-book ratio about how price-to-book and return on equity are somewhat complementary, and you can use the two in your screens. Okay, there have been some criticisms of the return on equity valuation metric. One of them you can see on the screen right now, an article from Forbes.com says why, the headline is why investors can't trust return on equity. Basically, the big criticism here is that return on equity is impacted because of stock buybacks when companies buy their own stock. This has the effect of increasing return on equity, but that is misleading. Return on equity is meant to suggest or reflect how efficient a company is with its assets in terms of generating income. When a company is engaged in a stock buyback, that doesn't really indicate that a company is more efficient in generating income. There can be a variety of reasons why it's buying back the stock. It does reduce the pool of available outstanding stock, and this does have a tendency of limiting supply, which in turn can increase the price of the stock. But overall, it's sort of a side effect of a stock buyback is that it sends return on equity up, and that sort of distorts the idea that return on equity is a measure of how efficiently a company is using its assets to generate profits. Since 2008, stock buybacks have become more common. So the idea here, as presented in this article by Chuck Jones on Forbes.com, is that return on equity has outlived its usefulness. I thought this was a pretty interesting argument. They put forth the idea, especially of IBM, pretty mature company that hasn't really had a significant change in its operations, but once they started doing a return on equity, once they started doing, a stock buyback program, the return on equity really went higher. So if you're screening based on, based on return on equity, something you may want to do to compensate for this is to add in a screen that accounts for a buyback. So, to screen out, look for stocks that have return on equity but are not buying back shares in significance. Now, when we actually backtest return on equity, and this is from fatpitchfinancials.com, they've got a number of great backtests on their site. I highly recommend checking it out. The classic screens, or the sort of criteria they're using for all of their backtesting, is to look at U.S. stocks only that are exchange listed, so no over-the-counter stocks, no ADRs, which basically means the company is operating in the U.S. The share price is going to be at least $1, greater than $1, and we're rebalancing the portfolio annually. So basically, at the start of each year from 2000, the backtested algorithm buys the stocks based on their return on equity, and then it recalculates, and then in the next year, it'll sell those and buy the new ones that have the best return on equity. I'm looking for a market cap of at least 50 million, and the daily trading volume is at least 100,000 shares. So looking for companies that have some size. They also, if a company doesn't have any return on equity, they removed that from the data set. And here's what they found. This is relative to the S&P 500. So the lowest, the bottom 20% of return on equity actually underperformed the S&P 500. And this makes some intuitive sense. Bottom return on equity suggests that they're not generating much income. They might be losing income. They're probably negative, so they're probably operating at a loss. So that makes sense. They're underperforming the S&P 500. The next, the next 20, 30, 20, second, third, fourth, and fifth quintile do actually outperform the S&P. So basically, if you have a positive return on equity, 80% of the companies, the top 80% of companies that return a valid return on equity number actually outperformed the S&P 500, which I think is pretty important. Now this, I should note that this study goes back from 2000 to 2013. So one criticism is that we're only looking at a 13-year period. The stock market has gone on for hundreds of years, so this may not be a large enough sample. That's something that critics may say, or maybe, reflective of macroeconomic conditions since now, right? Since 2000. Since 2000, the world has changed a lot, but it's a very different world than 1960s, 70s, and it might be a very different world than 2030s, 2040s. So whether this continues to perform, we'll see. As they say, past performance is not always indicative of future results. But what I thought was especially interesting here is that the fourth quintile and the third quintile actually outperformed the fifth quintile. So the stocks that have the best return on equity are actually not the ones that generate the most returns. So I thought that was something pretty interesting and worth considering. Okay, and that sort of ties to our next point, which is the rules of thumb. Return on equity is a percentage-based number, and that you're looking at net income, which is and dividing that by the shareholders' equity. Usually income is going to be smaller than the assets. Not always, but often. So if a company has 15% of return on equity, that's considered pretty good, and you may be interested in looking further more at it. 30% is considered very good. But 50% is probably too good to be true, and this relates to why, when we saw in our previous slide, that the companies that had a really high return on equity kind of underperformed. The highest quintile underperformed the third and fourth quintile. Fifth quintile underperformed third and fourth quintile. And that's because a lot of those companies, there's something going on where it's not actually performing as well, or it's not actually as efficient as it may suggest. And that could relate to the buybacks. It could also relate to those companies. Remember, this is not a price ratio, so a lot of that value may already be priced in, meaning investors are already on the scene. They know that these efficient companies are doing really well. But usually it's because those companies, there's something too good to be true, whether they did a lot of buybacks and that sort of inflated or created the impression that the company is more profitable and more efficient than they actually are. Okay, so now that we have this information, we can sort of take a look at a screener. And here's a Guru Focus screener, and I think it really shines in the context of the return on equity screener. It is a premium screener. I think if you rely a lot on passive investing, you may be interested in this product. Other screeners that members of Informed Trades have talked about and that are free are finviz.com, unclestock.com. That's one I like. It has some basic features that I think are pretty good. Google Finance, Yahoo Finance, they do have screeners as well. A lot of it depends on how deep your needs are. If you have pretty basic needs, then those free screeners will be fine. If you want something a little more advanced that gets into a lot of possibilities, Guru Focus or Premium Screener might be more to your liking. In this instance here, I set the default 15% return on equity, market cap of at least $50 million. Share buyback rate, so we can say, and companies that aren't buying back more than 5% of their shares. And you can either add other things like insider ownership. That might be if you want executives that own the company. If you want to make sure the company doesn't have much debt. If you want to factor for dividends, there's a dividend screener here. You can look for dividend yield or dividend growth rate as well. And of course, you can add in a price ratio, a price of at least $1. And here's some numbers. You can see that you can sort by return on equity based on the filter that I had. A lot of this is, here's a classic example. BPT. When you see return on equity this high, it might not be exactly what you're looking for. On the bottom end, here's at least 15% return on equity. So that's a little interesting. A lot you can do. You can combine it with others. Combine it with price to book ratio. Let's see the top 500 price to book ratio, and now you have 15% return on equity and in the top 500 of price to book ratio. And so you sort of get an idea based on that. Companies, and then you can filter from there, of course. That's about it. Any questions you have, anything you want to add, join us at informedtrades.com. Best of luck in your trading and investing, and we'll see you next time. Take care.